Let's go to what your expectations are. You have a buy rating on FedEx. You have a price target of 313. That implies about a 20% increase from where it is right now. What are you seeing in this stock?
So what we're seeing is this quarter, you've got a lot of pressure from weather. We're coming in looking for below consensus. Seasonally, they typically have pressure from the extra employees they've hired for peak season. So we think you're going to see continued pressure on results despite being in the midst of what is a $6 billion cost-cutting program. And that's really the leverage that we're going to see as we move through the year. So you've got some leftover costs from peak season, continued pressure on volumes that weigh on Express. We could see a quarter here where Express margins are almost at break even. I think probably the worst quarter we've seen at Express almost since we've covered the company. But on ground, we're going to continue to move up to double digits. And that's the move, as you mentioned,
right,
is the move to the next step, which is blending the two of them together and continuing that $6 billion cost-cutting program through Drive and Network 2.0, which is going to consolidate the two of them.
Yeah, so a lot of different initiatives all happening at the same time. Again, in June, they're supposed to consolidate the companies. I want to go back to Express. We're going to show the audience that bar chart once again. If you look on the right-hand side, the estimate for this quarter is 1.1% margin for Express, as you mentioned, pretty close to breaking even. Where do you see the turnaround in this business? In general, e-commerce seems to be shifting from air delivery to ground delivery. That's really where the money is to be made.
So there's two parts of Express, right? You've got both international, where, if you remember, a few years ago, they bought TNT.
Right.
They had some integration issues. They're working on cutting about $600 million of costs out of that, hopefully getting that toward break even and eventually toward profitability. And then domestically, it's about parking old aircraft. It's about reshaping that network that was built for faster growth. As you mentioned, it's now decelerating, probably growing, if flat at all, if not decelerating below GDP growth.
Right.
And so you've got to adjust the network for that. And that's pulling out costs, parking planes, consolidating sort centers. That's a big part of what the Drive program is until you get to Network 2.0, which is blending the two of them.
All right, let's talk about the ground business for a second. Some of their competitors, GXO and also Ryder, they've been citing softness when it comes to the logistics business and also e-commerce. How do you see that impacting FedEx? And also there's reports that they're in talks with Amazon to bring some of that volume back.
Well, I saw those same reports where it looked like they broke off the negotiations and are not going to be moving the volumes for Amazon. But maybe that comes back and they reabsorb that. If you remember, a couple of years ago, well before COVID, they effectively broke up with Amazon and stopped moving packages for Amazon. From their view, it was, hey, they're not paying enough to be on the network. So ground margins have gotten back to double digits last quarter. We expect them to stay at double-digit margins. And so we do look for slight growth, again, below GDP, but slight growth at the ground side as e-commerce continues to grow. But remember, they're more B2B, continuing to get those kinds of packages in terms of unit growth.
Is there anything else that you think investors should look out for? FedEx, more leverage to China than their rival UPS. How do you see that impacting the business? And also the macro environment that CEO Raj Subramanian flagged a while ago, calling for a recession. We haven't seen the recession, but we certainly have seen some weakness in certain regions that have impacted this business.
Yeah, look, and that's a big part of that international that I was talking about, right? If Express overall is near break even, UPS on their international side shows about 20% margins on their international business. Now, again, they are more European-oriented than Asian-based. FedEx historically had more Asia-based until they bought TNT. So you've got to, again, reshape that network. If you're running a network that is constantly flying aircraft, and volumes are coming down, that's a huge negative leverage that we've seen in this negative volume period. So you've got to react to that, and that's what they're doing. They're parking old MD-11s. They're eliminating those, and so you're continuing to shrink that network while still offering it. And that just means reshaping where your hubs are and how you launch those aircraft.